Welcome everyone back to this week's King's Crowd Investment Roundtable. I'm Brian Belay, your host for today. We have some amazing topics we're going to be talking about. We're going to be talking about the chart of the week this week that King's Crowd put out, where we looked at venture capital versus investment crowdfunding market data since 2018. We're going to be talking about Boxabl, their current raise. They're back again. They have a few nuances we're going to be discussing just in terms of Regulation A and how they have different series of shares that are being offered. And we'll be wrapping up with AptDeco, a investment opportunity that is currently live that the investment team has been looking at. Let's meet our guests that are here today. Teddy, how you doing today?
Doing great, guys.
Awesome. Teddy's one of the senior investment associates from King's Crowd. Thanks for joining us, Teddy. We've also got Scott Katoon. Scott, how are you doing?
I'm doing well. How are you?
Excellent, thanks. Looking forward to some good discussion. And last but not least, Leah. Leah was on a great investment recording last night, and she is back again. So how are you doing today, Leah?
Really excited about the insights we're going to have today.
Awesome. Yeah, we are going to be sharing and dropping some great knowledge, I think, just a lot of insights in terms of, we look at hundreds of deals every year, probably more, and King's Crowd has a lot of great data to be able to share some of those insights with all of the followers. The first thing we're going to be talking about today is the chart of the week. And for the chart of the week, what we looked at is venture capital versus investment crowdfunding since 2018. What we did is we normalized the data to 2018 values for the amount of capital raised in both VC and Reg CF, or investment crowdfunding. And you can see the bars here. So in purple, we're showing the investment crowdfunding market since 2018 normalized to that value. And in the teal color, we're showing venture capital. Now, obviously, venture capital is much bigger when we're talking raw numbers. VC towards the halfway through the year was around $90 billion invested, according to PitchBook data, whereas Reg CF will be estimating we're going to be coming in the end of the year around 330 million. So based on that, one of the things we can see is that both VC and Reg CF had huge run-ups in 2021. That made sense. It was kind of peak ZIRP, zero interest rate era. A lot of people were coming into the private markets with their cash. And what we have seen since then, not surprisingly, is both of these markets have pulled back. However, one of the things that we'll be stressing and showing is that Reg CF, as shown in the purple bars, has pulled back less, relatively speaking, compared to VC and teal. In addition, when you look at kind of the trends from 2018 all the way to present through 2024, Reg CF is around 4.5x where it was in 2018, whereas VC is estimated to be ending the year around 1.3. The other thing to take into account with this is VC has had some huge AI deals. So this includes, I think, CoreWeave's and xAI's multi-billion-dollar rounds in the range of $6 to $8 billion that is going into that, whereas Reg CF has not had some of those big outliers. I think first, I'll toss it over to Scott. Scott makes a lot of investment outside of the investment crowdfunding markets, and I think has tapped into some of the VC trends as well. But what do you think of this, Scott?
Well, in general, I can say that one of our investors for my company, Songfinch, Valor, did a 600 million, I think was the number, into the X.AI that you talked about. A lot of the AI deals are in the billions into like 3. Like OpenAI, who just recently had their CTO step down, so now it's just Sam Altman and friends. Anthropic and Drool. There's a handful of companies that like are dominating that space. Perplexity. They take up the majority of like the large check. After that, you're looking at a lot of funds, emerging funds in particular, who are investing in everything AI. Anyone who puts a domain.ai or adds AI to their masthead. Many of these deals are like wrappers. We're not talking about LLMs. We're not talking about transformational AI that's set to change how we do business or eliminate jobs. We're talking about, well, I guess tangentially it eliminates jobs, but like not intentionally. We're talking about a lot of companies that are being qualified as AI that aren't necessarily AI. And I think that today we'll look at that number and say, oh, look at the majority of companies that are, or firms that are investing in AI companies. Tomorrow, 2-3 years from now, you're going to look back and say that those weren't AI investments, and you're probably going to get not AI returns. So crowdfunding just keep on doing what it's doing.
Yeah, Teddy, Leia, any takeaways from your end in terms of what you're seeing?
Yeah, just to like hit the AI piece, I think you see this even in equity crowdfunding too, especially like the really early stage companies, like Scott was saying, like the ones that are just .ai. Like a lot of companies say they're AI, but they just have like one ChatGPT plugin, and then they say, we're an AI company, and they, beef up the valuation to something stupid. So we'll just say also, yeah, be careful of that in Reg CF, because it's something we do see here too.
It's definitely something Teddy and I are very careful when we analyze companies, when we talk to founders. We make sure to ask founders, what do you mean by AI? And that's one of the reasons why when we share that a company is a top deal or we rate it pretty highly, it's because we verify that there's an actual real AI claim behind the word.
That's always my first question. It's like, so what do you mean by that? Is it proprietary? Is it built? Because there are some companies that build on top of, LLMs and, in a very specific way that can become interesting. But if it's just like you have an integration with ChatGPT, it's like, no.
Do you own your data?
Yeah.
If you do not, your valuation is still 2.5 EBITDA.
Awesome. Well, let's move on because I know we have some other great topics we want to talk about. Next up on the docket, let's talk about Boxabl. I can pull up the raise page here, but Teddy, do you want to give a quick introduction just to Boxabl and a little bit of history for maybe people who aren't familiar with the company?
Yeah. Anyone else feel free to jump in as well, because there's a lot to cover with Boxabl. But yeah, so they're making essentially tiny homes, and they kind of fold into each other, so they're very easy to be transported. They come fully outfitted with the plumbing, the electricity, all of that, the kind of ports for that. So it's kind of meant as an addition to a home, or an office space addition to a home, some things like that. They've also had some traction with government, some government contracts where they're implementing some of these casitas, I believe they're called, into some like military bases and stuff like that. But they're really a very frequent equity crowdfunder, probably one of the most successful in terms of dollars raised at absurd valuations. Sorry. And so yeah, it's an interesting one to look at and talk about now that they're back at it.
Yeah, just if you take a look at this valuation chart, their first crowdfunding raise, actually, if you invested back in 2021, you could have gotten in for $42 million valuation. Following round 226, and since then it's been $3 billion and north of $3 billion.
Scott, was that fist pump? You got in early?
We had him on right about then on the original Pitch Reviews Instagram series we did, and I put in it wasn't much. It was like $2,500. So it wasn't like a ton of money or anything, but I was a big fan of the idea. We're gonna get to all this, but there's a period of time where we're rating them like 4.5, and now we're talking like 1.6, and the net rating is 2 or whatever. But when they were doing hundreds of $1 million valuations, it's still rich, but it's not inconceivable that this could be a thing. And I think one of the parts, I want to save this part for the latter part of this discussion on Boxabl, because I don't want to get lost in it. There is a future in the techno-industrial world where you can see people who cannot normally afford homes own their own home. And we've gotten to a place, I'm just talking about my own suburb, that my house was $600,000 and now I could sell for $1 million, and it has nothing to do with my home. It's the land. So if you want to buy land and put a Boxabl on it, and in their original pitch, add Boxables to it, it would be effectively you're just your investment is in the land. And maybe someone will buy your combo Boxabl, but they're minimally buying the land. We've gotten to a place where AI is part of it. Materials and cost of materials is part of it. People's interest in having a house that looks like a truck bed is part of it. But it just doesn't work. Like, you just can't come into Glen Ellen or wherever I live, wherever you live, and be like, oh, the fifth house on the lot is a Boxabl. It just like doesn't work like that. There is, however, a future where it does work, and there's definitely certain parts of the country where it does work. And I think that at a sub $100 million, sub $300 million value, the opportunity is huge, and the innovation that's coming from it that will inspire other companies as well as Boxabl's own innovation is huge and worth the investment. And I think that we are right now in this like weird holding period where innovation and technology hasn't quite caught up to enable Boxabl to unleash that value that is in the multi-billions. And I think that they benefited from Elon Musk claiming to use a Boxabl in Austin or wherever he was when he did the Gigafactory. From a company in sector and investment standpoint, there's absolutely a future where we are able to buy land and put a home on it that is suitable to our needs more effectively and more cost effectively than we do today. And Boxabl could play a role in that. However, there's another 15-minute conversation that's going to take place about Boxabl itself. And I'm not part of that.
Yeah. I mean, it's, once that becomes more kind of mainstream, kind of, putting these more efficient and fairly priced kind of mini homes, if you will, it's a question of if they're going to be around at that point, just given. So like if you look at their financials, their gross margins are, very deeply negative. It was like negative 3,000% or something at the end of 2023. It's like a little bit better now. I think it's like minus 600%, negative 600%. They obviously have a long way to go in terms of getting the manufacturing side to a place that's scalable in any real way. And something that they've, for years been saying that they're kind of on the verge of getting to. But I think, again, with this valuation at 3.4 billion, it's like they haven't priced in this massive risk that they still haven't figured out yet.
I know new investors want to see everything about them, but it does include past investors. And if they were to do this round at, say, $1.4 billion, or, I mean, they're not going to do sub $1 billion, but like in that vicinity, the implications are that they would potentially lose some of the loans that they have that they're using to build. They would owe money immediately based on valuation, based on order volume, that would negatively impact everyone else who's invested. So like part of the pricing here, and this is something people need to pay attention to when they start investing in companies of this size, is that it's not simple. Like, I've built a company, I'm valuing it X, I have X sales. They have debt, they have manufacturing, they have other partnerships that require certain things to be true. So like, I don't necessarily knock them that they're valuing. I don't think this value is crazy, but like, I don't think that I understand why they would value the business probably more than it should be worth. They're also trying to price into this that the future they believe is where we can basically build these little mini homes and modularize our home building in a more effective way. And they believe that they'll have the innovation to do so. It creates a little bit of a problem for the investor, because you look at this company and their sales are not equatable to like their valuation. They're trying to say that this world is going to be filled with modular homes. In the same way, pun intended, that Elon Musk would tell you that the world is filled with Teslas. And I think if you know consumers, while value and efficiency and ease and all these things play into it, nobody wants to have the same car that every single person on the street has. And it's like modular homes, until they're more customizable and more identifiable, you're not going to see 45, like not in a normal suburb. You're not going to see 45 modular homes. So I think they have to figure that out, and they have to become far more usable and applicable to other people and create different things. And they just didn't price that in. And like, I think, obviously, I know we're going to dig deeper into the founders and how they're spending the money, but like from the surface, I don't think that there's any problem with the space. I don't think there's any problem with an investment in a company believing that you're going to get to a place where you create your own materials and 3D print homes and it's cheaper. And So like, I think there's a future here where it's like really good, but at the price they're at, it's, in my opinion, I'm not speaking for anybody here, but like my opinion is they're pricing in the founder's desires more so than they are the customer's needs, is my opinion.
If you're an investor today, I think the opportunity was way less exciting than when you invested, Scott, also because the competitive landscape is completely different. Teddy and I see at least one competitor raising every month. And so for the last couple of years, they're not the only one in the modular home market. And there are a lot of very good companies that are doing similar things. So
Yep.
the revenue to valuation multiple isn't justified. The differentiation is low, and that's not justifying the valuation. And I don't see right now a future where an investor investing today at $3 billion could make a 10x return in 10 years or less.
I see no place where there's a 10x return on this for investors that are post $1 billion. I'm sure there's a scenario where they're a $10 billion company, but I find it hard to believe that sub 1 billion, you're going to do more than that. And again, not to tie this back to Elon and Tesla, but like when Tesla got started, they built their powering network, right? Like the differentiator is that everyone else had electric cars and that was a problem. But Tesla, you could charge on the way. So like there was like an advantage to being a Tesla owner versus other electric car. When Tesla started, there was very few electric cars brands, at least, that were like investing heavily into it. BMW had their like shit beater that I owned. But like there was a handful in the Boxabl home space. It's not the same as cars. So like they're in a situation where like Tesla got Main Street before other people, Lucid and others, and Polestar and whatever came in, and obviously every manufacturer since. This is a business where like you're one of a million, and there's like really not differentiation. Once you figure out how to 3D print or create homes inside of a factory that are moldable, everyone can get in that space. It's going to be very difficult. It becomes a brand game at that point, and I don't see them making moves towards that. I don't see that.
To keep things moving a little bit, there was a couple quick nuances we actually just wanted to highlight as an education opportunity for investors who look at deals that are similar to this, such as done under Regulation A. So the first thing you'll actually notice here in the funding chart on the King's Crowd page, they had $7 million in commitments back in June. This is because Boxabl was testing the waters at the time. Now, what tends to happen when companies flip from testing the waters to live is that only a small fraction of those actually turn into real investments. So that's this big drop off that you're seeing in the chart. And then it's starting to come back up, both as some of those investors go to commit, but also as new investors are coming in. The other interesting thing with Boxabl is that, and this is unique to Regulation A offerings, it's being done on multiple platforms. So you can actually invest in Boxabl on Start Engine. Start Engine is one of the placement agents for this raise. So you can invest in their Series A3 shares through here. Same price, minimum deal terms, same things. But you can also invest at the Boxabl page at boxabl.com/invest. Now, the one thing that we want to point out as kind of another nuance of why you always want to read the offering circular is when you're on the Boxabl page, you actually have the option to switch to the Series A offering or switch to the Series A3. Now, investors who click that might say, what's the difference? The minimum looks the same, the share price is the same. If you actually go into the offering circular, the difference is that if you're investing in the Series A3, those proceeds are going to the issuer. They're going to go to Boxabl directly. If you invest in the Series A offering, those are actually going to secondary insider shareholders who are selling their shares in this round. So just be aware that as an investor, if you want your funds to be going to that issuer and actually making sure that the capital is going to be used towards growth versus giving some compensation to some employees who are selling shares, then make sure you're investing in the right series. This is very rare, but just another good reason why you need to make sure you're reading all the documentation, and why, of course, at King's Crowd, we're going to be pointing out some of that to you.
You're going to see a lot of this in the future, and it's not wrong. It's totally okay. A lot of these people are putting up a lot of their own capital to start stuff, and like secondaries and so forth are, it's no less valuable. Your stock is no less valuable. If you go into the forums and you find out how much the Boxabl founder and his father are making in this, we're talking like 1.6 plus million a year that they're paying themselves based on what they last reported. I think there's a huge world where we do secondaries on these platforms, and I think it's totally normal and acceptable. And I would say in the Boxabl standpoint, like it can't be easy to get something like this off the ground. And you absolutely deserve, when your company's in the billions, you should absolutely, as a founder, as one speaking, like to be able to take money off the table, like that's okay. You're buying equity in the company. You're not buying equity in like me getting money. It's irrelevant. They're not delivering the Boxables at a timely order relative to like the order volume, and they're paying themselves like they're running Starbucks. And I think the problem that people have, the reason the forums are like hot on Boxabl, the reason we're talking about Boxabl, part of it is that they're doing a 3-point-something billion round. Cool. But the biggest reason we're talking about is that there's two guys, father and son in this instance, who are making a lot of money. Like these dudes are making like $800,000 a year, and they're not delivering Boxables. And I think like when you talk about the analyst stuff, it's like parts of this business I could get you to $5 billion in a value. I can get you to $10 billion. But when you sell Boxables at $30,000 to $80,000 plus a unit, and you're delivering sub 25% of the units, and you're paying yourself like you're delivering 100% of the units, and you've taken secondaries on a company that is not technically product market fit, that's difficult. And I think the problem that some of us had, speaking for myself, only myself, as an investor in the early days, is like, I would love to use Boxabl on my portfolio as I raise money. But I can't, because they haven't delivered on much of what they promised, and they've paid themselves very well. And I'm not saying that they shouldn't pay themselves well, but this is really well, really well. And now they're running a round that pays into the company and them, like they're like, hey, we didn't pay ourselves enough. We want more money. You're still not delivering units at a pace that I would expect. So like, this is all I'm gonna say. Elon Musk used the product, and he didn't back it, and he didn't support it, and he didn't double down on it. And it makes you wonder, the fact that they didn't deliver something, he was like, holy shit, I should be all in on this. And now you're saying I'm going to run a dual round where like part of it goes to pay me and part of it goes to pay the company. I still think they have a huge upside. So I'm not saying it's a bad investment at all. But I do have questions, and I have the same questions for every single company that raises crowd or private for that matter, that has not met the milestones that as a normal investor I would expect to see. I expect that you hit a certain sales volume, and then you say, hey, we've done X dollars in sales, we're raising at $3 billion. And Elon did this with Tesla, it was a huge fucking issue, right? That if he delivered a certain amount, that he got this ridiculous package as a payment. And like it went to literally the United States government to determine whether or not it was fair. But he exceeded it. All right. He set a huge expectation. If he delivered X, he got Y, and the Y was fucking ginormous. These guys set an expectation that was X, and Y wasn't ginormous. It was just that you fulfilled what was sent to you. And they didn't deliver, and they're trying to get paid. And that, to me, that's my issue. I have no issue with the valuation on the deal, on its pace. Like, I get why you got to do it at this. My issue is that you're trying to raise money that ends up paying out people in the company that haven't performed.
There's nothing that's black or white in this market, right? Everything, you got to look at it in the context of not only what's going on with the company, but with your own goals. You know, there may be certain people for whom this checks all the boxes, and maybe they're not looking for a 10x return, and maybe this is what they want to support, versus some other people have different goals. So I think that's one of the reasons why, again, King's Crowd, right, brings and surfaces a lot of this stuff so that you can make the decision for yourself, whether it's a good fit or not.
I always look at gross margins over time, and like, I get this is very difficult, but they're getting worse over time. And it's like, for something with this much risk, like I want a 10x possibility, and like at this price, I just don't see it. So
that's one of the big lessons I think that I first learned, is that the difference between a great company and a great investment opportunity, two completely separate things. So you need to look at them both, right? You can invest in a great company at really bad terms and also vice versa. So just keeping that in mind. All right, let's move on to AptDeco. So this is a deal that the investment team has been considering and taking a look at. I'm going to turn things over to Leia, and I'll pull up the deal page here. Tell us about AptDeco.
Yes, AptDeco is becoming the next Vinted for furnitures. So if you're not familiar with Vinted, Poshmark, these are secondhand platforms where you can buy clothes that were previously loved by their owner, but that are now being resold. AptDeco is doing the same thing for furniture. And why is this exciting? Because the second-hand platform for clothing have seen a dramatic growth in the last couple of years. Companies like Vinted or Poshmark or unicorns, but the furniture space did not see anything like that happening. And the reason is that there are several challenges. It's not as easy to buy a couch as it to buy a jacket, and it takes way more effort to ship it across the country. So what AptDeco is doing is bringing a platform where sellers and buyers can filter furniture based on the brand, the price, the color, the expectation to really have a sleek experience and offering easy delivery. So AptDeco has its own delivery system in the northeast of the United States and is using other carriers for the rest of the country. What is very exciting about the company is that it already reached $6.5 million in revenues in 2023. And so we see that there's real product market fit, there's a real traction. Of course, there are several questions. Is the company going to be able to grow further? Is there really a bigger market? Are people willing to buy the furnitures on a platform like that? And the answer is yes, for a couple of reasons. But before I go further, I want to get kind of Teddy's opinion on the company.
Yeah. So one thing I wanted to ask real quick was like whenever I'm looking at your platform, two-sided platforms like this, marketplace platforms, I wonder if the revenue is like the gross merchandise value of like just sales on the platform, or is it like net revenue of like this is what AptDeco is like taking home after taking their take rate. I believe this is net revenue, right?
Yes, this is net revenue, and we can see that the profit margin really increased between 2022 and 2023. So they had, I want to say, only 10-15% gross profit margin in 2022, and in 2023 it looked like they already reached 50%. So they've been able to increase the gross profit margin as well. They also have a very interesting CAC to so customer acquisition cost to customer lifetime value ratio of 4.1.
Yeah, GMV, when people talk about GMV, just to simplify it real quick for those who aren't aware, right? So let's say that they sell a piece of used furniture for $100. That would add $100 to the GMV, the gross merchandise value. So that's like how much dollar value is transacted. Now, all of that doesn't go to AptDeco, the company, because some of that's going to go to the seller who owned that. So they're going to have a certain take rate, which I believe it was, do you remember, Leia, off the top of your head?
The take rate was between 13% and 48% for AptDeco. So it can be actually pretty large.
So they're almost taking up on some transactions. It sounds like they're actually almost taking up to 50% then. But
as you may know, investing in peer-to-peer platform is very risky because it's kind of a chicken and egg problem. In order to keep the company growing, you need to always attract more sellers, but also always attract more buyers. And why we really like the company, it's because it found a way to solve this problem. AptDeco has partnerships with large furniture brands such as West Elm, Pottery Barn, Article, and AptDeco is managing. Sorry. Yep, definitely. And it's managing the returns and the outlets for these brands. So that means that AptDeco is directly reselling on their platform the returns and outlet of all of these brands. And it's allowing it to really fill the supply side of the platform and offer a lot of choices to the buyers.
Got it. Yeah, that was one of the parts that was really interesting to me, where again, they have somewhat of this D2C, direct to consumer, really a C2C kind of consumer to consumer model where one person can sell their used furniture to another. But one of the interesting business opportunities that, Leah and Teddy uncovered is that, again, they're going to some of these other partnerships where people will return it to the stores and then they're able to sell that inventory for the stores. So it's kind of a B2B play or a twist on their platform.
This working in partnership with some of these very large, well-known upscale brands like West Elm makes total sense. And I think it's what makes this business scalable as opposed to just like burning money on social media ads to like get people on there. It's like, this makes a lot more sense and I think makes it more attractive from an investment opportunity, like significantly.
It also makes it more defensible because the founder has been able to build a back-end platform that can automatically manage the outlet and return sale of these companies. So what AptDeco is currently achieving is that if you're a customer, you're returning your couch, before you even brought it into the store, AptDeco already published on its website that the couch you're returning is available for sale, and you may have a customer already buying it. And therefore, instead of bringing that couch back to the company's warehouse, like West Elm, it may go directly to a new buyer and really save a lot of money for these furniture stores in terms of warehouse and stock and storage. And this is where there's a hidden potential of this company. This technology platform could be actually white labeled and sold to many other companies that are managing returns and outlets. And so it's not only a peer-to-peer marketplace, it's also a technology that can be finding B2B customers. And that's where AptDeco is really playing on different sides thanks to its technology. And that can also limit the risk of the investment.
In terms of competitors, because, when you first say, okay, it's a platform to sell your used furniture, doesn't sound that necessarily groundbreaking from the get-go. But I know there was a few competitors out there, Kayo, who raised, I believe, a 36 million Series B in 2022. They are actually shutting down. And Leah, maybe you could talk a little bit about why they're shutting down and what the strategy is that's different here.
Yes, Kayo was actually taking the furniture from the sellers and storing it into its own warehouse, which was incurring very heavy cost. AptDeco is not doing that. The sellers, similarly to Vinted, are keeping the furniture into their house until somebody is selling it. So AptDeco is really learning from the mistakes of its previous competitors and cutting the costs right here. There's another company called Cashew, which is based in San Francisco and is very similar. It seems to have some traction as well. We found that Cashew will only have $350,000 in gross merchandise value in 2023, which is nothing compared to AptDeco's revenue of 6.5 million. So they are definitely behind. Other competitors include Craigslist or Facebook Marketplace, for example. The problem with these firms is that the selection is not very curated. You just have to scroll for hours before you find something. Then you have to go back and forth with the seller. There's no obvious shipping solution. There's a risk. Your purchase is not as protected as it would be with AptDeco. And then you have stores like Goodwill, Salvation Army, or other physical secondhand furniture stores. I don't know if you've ever been into one of these stores, but to me, you go in there and half of the stuff are your grandma's furniture, the rest are super expensive, and it's just not what you're looking for. So AptDeco is surprisingly entering a niche and offering a solution that was not there yet. Of course, there's a reason why it was not there yet. And we just talked about it with Kayo shutting down. It's difficult, it's capital intensive, but right now, AptDeco is one of the leaders in the space.
Yep. Awesome. Well, I'll make sure we respect everyone's time here. So check out the King's Crowd deal page. So they are raising with a $40 million convertible note, currently a 20% discount. And again, given their financials with the revenues of 6.5 million, could say, somewhat fairly valued if they can continue to grow and expand at the current rate. Anything else before we sign off for this session?
Only thing I would throw on that is like kudos to Teddy and Leah for finding this. I think this business is going to become huge. I think eBay, we didn't talk about eBay, but like eBay is one of the biggest competitors where you're buying everything. And the biggest problem is that if I have a couch or furniture in general, I can't ship it. I don't ship it volume to where I can get shipping discount. I can't speak to their technology, but I can speak to the fact that shipping stuff is incredibly expensive on a one-off. If you look at like the high-end purse and fashion network, it's very similar in that like it doesn't cost that much to produce. It's mostly brand that gives you the value. So these companies can afford to take a huge haircut. And if you're West Elm, it's super valuable to say, hey, we don't actually have to restock. We can just like let you sell this. So like to the white label part of this, they can do that. I think that's like the biggest up value in this. In general, I think this company has a lot of potential. Like a lot of things can happen. It can go south, but like the biggest potential to me is furniture. We just like use it and I'm like tired of it. And aside from like a broken leg, it can be reused. And there's really not a great way to do it. It's Facebook or Craigslist local, eBay local, and nothing else. And I think this is a massive opportunity as long as you can solve for the storage. You cannot afford to ship it to you, store, and ship it out. It has to be shipped direct. And if you can find people to buy stuff in the early term and cut out that middle part, it's a massive business. $40 million is probably too high. Their revenue is good, but like it's probably too high for like an investor to be like, oh yeah, shit, I can see this is a $400 million company. But as a $150, $200, $300 million company that ships direct and it's basically a reseller, like you list it and then you keep it until we find a buyer. If they can master that timeline and like they cut out the products that people don't want to buy and they grab a sofa, so to speak, it's a massive business.
Awesome. Thank you, everyone, for the amazing discussion today. We'll wrap things up here and save it for next week. Again, signing off, this is the King's Crowd Investment Roundtable. Make sure you go and subscribe to our newsletter, Pitch Reviews, to get more great insights like this delivered to your inbox every week, or head over to the King's Crowd platform and you can check out all of the deals that we've talked about today, the charts, the data, and everything else. We'll see everyone next time.